Well, folks, as we do every week, we got to talk about the stock market. What is going on with the stock market? Ups and downs. We can talk about PPI inflation. We bring on the one and only Mr. Dan Bird to have these conversations. How you doing, sir?
I'm doing well. How are you?
I'm doing well, man. So, what's going on in the market? Obviously, the big thing from an economic standpoint last week was PPI, and I think it exceeded all expectations to the downside. We saw the 10-year note fall. I think it hit a low of 3.38. So
Yep.
lots of stuff
Came,
going on.
came
What'd you
back
see?
came back up at the end, but it's
It
still
did.
under 3.5.
It did. Yep. So what did you see? I'm curious what you saw.
Well, there was some hawkish talk from the Fed, which
Mhm.
I think the market is beginning to expect that,
Yeah,
actually.
I wish they would. I mean, that's they only have two things. They got this federal funds rate, which they move every 6 weeks, and then they have their voice. They're going to talk tough. They can't do anything else. Right?
Yeah,
It's
especially once we get into recession.
yeah.
You
Yeah.
can't do
So
anything else.
again, yeah.
By the
So
way,
the other go ahead.
go ahead.
I was going to say the other thing that I think is going to increasingly happen and will warrant further discussion is as we get closer to the terminal rate, which I think we are two small moves away from, you're going to see the Fed bifurcate. You will clearly see doves and hawks. Until this moment, they've been all on the same side. I think that changes after February 1st.
Um, I don't know if it's February 1st. I think
Okay.
what's going to happen is February 1st. There might be one more after that in
Yeah,
March,
I think so. Mm-hmm.
and there might not be,
They're
but
true.
there definitely will be one in February. I think February 1st, quarter of a point,
Mm-hmm.
and I think then you won't see it bifurcate at that point. I don't think.
Okay.
I think
All
what
right.
you'll see is they'll all start talking about we may be leveling off now,
Mm.
and we're just going to keep it there for a very long time.
Okay.
So the
All right.
narrative I think will be the length of time they keep it where it is.
Yeah. See, I don't. So all this stuff is possible, right? I actually think there will be four or five Fed presidents that actually give lip service to 5.5, 6%, right? These are what we would call hawks, and then there'll
Yeah.
be folks like Brainerd and others that'll say no, we could be done or we're almost done because I do think we get that extra kick of a quarter in March. But no, I think there's going to be some Fed presidents that flap their gums, and Jerome Powell may be one of them that
Mm-hmm.
says we're going to 6. So I don't think so. But again, we'll find out very soon.
Yeah, I don't know. We'll look at some things today that might shoot some holes in that.
Awesome.
But
That's why you're here. Show me where I'm
yeah,
wrong. Show me what I'm missing.
yeah, we'll see. Let me show my newsletter, and then we'll talk about a few things.
Mm-hmm. Go for it.
All right. So I do this newsletter every week. I think most of your regular listeners know about this by now,
Sure.
but I still get, some new folks that request to get on it. There's no charge for it, so it's just a kind of a compilation of the research I do every weekend.
Mm-hmm.
And I send it out to folks. So if you're interested, just send me a note to breakpointtrading@gmail.com. And I'll put you on the list. I'll send you last week's newsletter and I'll add you to it for the future.
Okay.
And if you ever want to be taken off, just send me another email. I'll just take you off. It's very easy to do that. So
Hmm.
no big deal. And I put these little cartoons in. You didn't have a chance to see the newsletter this week, right?
No, I did not. I look at Janet yelling, "We're not in a recession."
Yeah, she's inside the bear.
Yeah, I saw that. Yeah, it's funny.
And then this one I thought was appropriate. At least we still have jobs.
Yeah. Oh, those are Apple
Inflation,
news.
recession,
Look at that. That's funny.
fewer and fewer people with jobs. I don't know if you go on LinkedIn very often.
No, not very often.
Yeah, I go out there. I actually post some things sometimes about once a week. I'll post a chart and talk about it a little bit.
Mm-hmm.
But it's amazing how many people out there now are talking about just getting laid off. Of course, my network, of course, is mostly technology,
Sure.
right? So Google,
Yep.
um, Amazon, all the big ones.
Sure.
But you kind of should expect it, I think.
Mm-hmm.
This is the PPI from last week.
Yep.
I'll show you what it actually came in at, but this actually is a
So what is the red line telling us? Is that
The red line is the linear producer price index going back to 1957. If you just took a linear straight arrow straight through it, through the
so what's that
middle.
like? Is that like 4? What is that?
Well, just below 5. Yeah, it's probably around 4, close to
Okay.
4. And then
Right.
this is
Yeah.
that's what it actually showed.
And we were 6.5 last week.
Right.
Okay.
And then this over here, all this was in my newsletter.
Mm-hmm.
But this is something that I had talked about before. I said that the 10-year yield inversion, usually the recession doesn't begin until the inversion begins to uninvert,
Okay.
not when it's inverted.
Right. Correct. Mm-hmm.
Right. So this kind of gives you a view going back to 1957, shows you the start of the recession. So we'll just take the first one. Start of the recession was in September, but the first inversion was in April
Of the preceding year.
of the year before.
Right.
So 16 months from the time of the first inversion until the recession started.
Hmm.
And then they have a 3-month rule that basically says it needs to be inverted for at least 3 months. So for the
Okay.
2020, for instance, COVID, it had inverted 6 months early, but it never stayed inverted for more than 3 months.
Mm-hmm.
All right. So, if you just look down here, this is the last one, the most recent one here. Recession started in 2008, but the inversion happened in December of 2005, 24 months between the time of the inversion until the recession.
And it was inverted for 18 months.
Right.
3 months. Wow.
That's right.
So it can stay inverted for a long time.
That is my point. You can't, panic because it's inverted. Yes,
Yeah,
it has a pretty good record of forecasting a recession.
right.
But you can't panic as soon as it inverts. You should start panicking when it starts uninverting.
Yeah, and if you look at that, the average, oh, there it is. You actually have the
Right
average.
here.
It's
Yeah,
19 months.
that's right.
That's a year and a half, folks. We're
Right.
sick. We got another year. So this, again, just using this chart. So here we could expect it to be inverted for another year.
Yeah, 9
So the
months actually.
recession might be, no, a
Oh,
year.
I'm sorry. Yeah, you're right. It could be inverted, but the recession, where I got this from, the recession, according to this, if we go by these numbers, is about 9 months away.
Oh, got it. Got it. Okay. I see. All right.
So sometime in Q3, end of Q2, beginning of Q3, somewhere in there.
Yeah.
For a recession.
Okay. Very cool.
All right.
Wow. All right.
I want to show you something else. This is something I was just playing around with.
Sure.
Pretty interesting.
Mm-hmm.
I know the one on the right is a little hard to see, but I was trying to make it bigger just to make it equal to the one on the left.
Oh, okay.
So they look fairly similar, don't they?
Sure. Yeah.
Right.
Yeah.
So what time frames were these? Well, the first one on the left
No idea.
is right now.
Oh, okay. So these are monthly
These
bars?
are, yes, these are monthly bars. Correct.
Okay. Got it. All right.
So the one on the left is from 2020 to 2023.
Okay.
So that's current state.
Oh, don't tell me the other one's the .com era.
Do you want to make a guess when it was?
I'm gonna go.
It's a pretty big drop there. Kind of like what happened at COVID. In COVID,
Yeah, I'm gonna go 01 to 03.
not quite.
Ah. Oh,
19,
87.
1987 to
Ah,
1990. That was the
the
87 crash.
Black Monday.
Right.
Interesting. I should have guessed that. Black Monday. That's a big ass drop. That's
So
20%.
1990 looks, and then look what happened after that big drop.
Yeah,
Market just screamed higher.
well, it worked its way higher these 3 years. I don't know if I'd say
Yeah.
screamed.
Well, it looks very much like the one on the left.
No, I agree. No, that's very
2020 to
interesting.
2022.
Yeah, I would. Oh, that's interesting. Okay, I
All
see
right.
it. Yep.
So now let's look what happened. I love doing these historical comparisons,
Yeah.
right? So let's see what happened in 1987.
Okay.
So those are the two charts right there. Now, of course, in 2023, we can't go any further than that because that's where we are, right?
Sure. Yep.
But what happened after 1990?
Yeah, that's the question. Dan, are you telling me we're up for a 300%? Is that what you're telling me? I don't I don't know what the scale is, but that looks impressive.
It does, doesn't it?
Oh, that's just till 2000. That's not even to 2020.
That's only till 2000.
So that's just
This
the
is
next decade.
Yeah, this is the secular bull market.
Oh,
It started in 1982.
So what do you happen to know what the scale is? Like where were we at the bottom of this is S&P, I guess?
I don't know. Yeah, this is
That's
the
okay.
S&P.
But yeah, you can clearly see it's up. That's a bull market run. Now, Dan, just so you're clear, that is screaming higher.
Yeah, that is screaming higher, but
Yeah.
this is I've always talked about secular bulls and secular bears, right?
Sure. Yeah, yeah.
And the 1987 crash was a cyclical bear market inside of a secular bull,
Mm-hmm.
right? The secular bull started in 1982 and went to 2000, 18 years. So this here is just the last half of it after that crash in 87.
Yep.
The one where we are now, the one on the left is the crash of COVID.
Okay.
And I've maintained, and I'll show you the chart again, but I've maintained that we are in a secular bull market right now.
Yes, you have been remarkably consistent.
Right.
Okay.
So let's take a look at some of the charts.
Sounds good.
By the way, just before, about 10 minutes before we started this, my browser crashed.
Oh, sorry.
So I had to rebuild all of my charts.
Yeah. Frantically rebuild. I apologize for that.
Yeah. But I'll run through these pretty quick. And then the next session, we're going to talk about, we're going to do a sector review of all the sectors and the large cap technology names. And I'll talk about Darvis boxes there too. This was in my newsletter as well.
Okay.
Anyway, I thought I'd start with the VIX. So as you can see, the VIX is inversely correlated to the market, to the S&P.
It's sub
normally.
20. I saw that on Friday. It went sub 20.
Sub 20. Wow. So the way I set this up, I've got a 5-day and a 21-day. The 5-day is red. The 21-day is green. The actual number is the gray area,
right,
kind of in the background. Okay. But having a 5 and a 21 allows me to see where they cross when the trend starts to change. And then I color coded it because it's inversely related. The colors relate to the trend of the market itself, not the trend of the VIX. Okay. So what that means is when the VIX goes down, the market goes up.
Got it.
Okay. And you can see it down below. This is the S&P down below. Kind of drew lines where these crossed. It started to become green right here. And you can see where that happened down here and the market trended higher. And then we had this little head fake right in here where it looked like the VIX was going to start taking off again, but it didn't. In fact, we actually had the market drop right here. If you remember that, we talked about it on this channel. The market dropped, but the VIX kept dropping too.
Yep.
So it was correlated. It was not inversely correlated. It was actually correlated, which is very rare. That doesn't happen very often.
Yeah, I remember that discussion from December. Yep.
Right. And then right now we're clearly in the green.
Okay.
So that looks like good news. And here's the 10-year treasury down here.
Oh, yeah. It's just anchored on that 3.5.
Right. It's right on the 3.5. It's actually broken through the trend line from way, way back here.
Oh, yeah. Look at that.
Broken below that trend line. So that's good news for growth if that continues. Next one here this is the chart that I showed last week. This is kind of the go-to status of where we are. This has 2 levels of Fibonacci on here, and I've circled where the 2 of them are basically at the same point. The first one is right at about 4,000. And you can see last week we came up to 4,000 and got rejected.
Yeah.
Went back down until we got to Friday.
Okay.
So it looked like it was going to be the same old thing, same thing that's happened all year. We go up and hit that line, especially where the 200-day moving average, we hit it, we drop down and make a new low. So bear market rally, bear market rally, bear market rally, bear market rally.
Hmm.
But this time we didn't go down and make a new low. This time we started back up again, but then got rejected right in that same area. Now this time it's right at the 2 Fibonacci layer levels at 4,000.
Okay.
Friday was very encouraging, and I'll show you some other things that look encouraging as well. So we had a big rally on Friday, came back up. It actually ended, let's see, it ended at 39.72. This is the S&P. And 4,000 is the key level right now.
Okay.
So the question is, are we going to continue going up and break through it finally? Or will we get rejected again, head back down? We'll find out.
There you go.
Interestingly, and I forgot to mention this last week, but this was last week was options expiration. And normally options expiration week acts the opposite of what the market's been doing. So going into that week, the market had been going higher. Normally options expiration, the market makers want it to go down so they don't have to pay out all that premium for options. And that's exactly what happened, except for Friday.
Okay.
All right. So keep an eye on this. And remember, too, I said that once it gets up above 4,100, right up in here, which is where this high was, there's lots of shorts.
Short covering, yeah.
Short covering that's going to go on right in there. All these people that have been short all year.
Yeah, I mean, well, something that's very interesting that like looking at a totally different market, crypto market, Bitcoin has been screaming higher for the last week or so, and I think a lot of that is probably short covering. Would be my guess.
Could very well be. Yeah, you can see the next level where the 2 Fibonacci's meet is up here at about 4,300.
Okay,
which has been a really important resistance level. So if we get above 4,100, I think it's going to definitely make it to 43, and then we'll see what happens. Probably we'll go sideways for a little while.
Okay, sounds good.
All right, so we'll see. Keep an eye on that. By the way, you're going to be gone in February, right?
Yep.
So I'm going to try to do some individual videos.
Should be fun.
Using Zoom. And what I'll do is I'll just do an update on some of these charts just to see where we are as we're going along.
Yeah.
Since I'll be talking to myself mostly. May or may not be in agreement, but we'll see.
When you start disagreeing with yourself, that's a problem.
Yeah. This is the commodities.
Oh, this is the one I was afraid of. I actually have
look at that. Look at that.
Inflation. Oh no.
Yep. CRB, gasoline and oil and lumber too.
Yeah, I have a sneaky suspicion inflation may
rear its ugly head again.
Yeah, might surprise some people next month. Oh, that's not a good chart, dude. That's not good.
Yeah, that is not going to be good. So the next CPI number is March, right? No, February. February 12th. Yeah, I think it's February 12th. Yeah, that's not going to be good if these continue to go higher. Now, if you follow them across, you can see where they were before the very first Fed rate hike.
So it'll be a February report. So January of the preceding year will roll off.
Right.
Yeah, not going to be good.
Yeah, that might be concerning.
Yeah, you're definitely going to get You're definitely going to get another Fed rate hike in March if that's a problem.
Yeah, if this continues like this, yes, you're right.
Yes. Yeah. Okay.
It's breaking a new highs right here.
Yeah, that's not good.
This is December high. Both of them are December high, beginning of December, end of December.
Yeah, gas is up like 20% or 18% or something. So it's very nerve-wracking. I don't know, dude. I don't know. It's going to be scary.
Yeah, we'll see. This is my long-term chart, and this is what tells me whether we are no longer in a secular bull market, like what I talked about before.
Yep.
So we're still hanging in there.
Yep, you're still confident. I like it. I like confidence.
Yep, we're still above these levels. I'll show you some things here in a second that are starting to look positive, actually.
Okay.
And then this is the chart that I did for the January barometer, January effect.
Yep.
We talked about this last week, but this is one that I'll keep tracking until the end of January. So this is one that I'll do in that short video that I put together.
Yep.
There's 3 criteria. First, the Santa rally. Want that to be positive. Second is the first 5 trading days. This all comes from Stock Traders Almanac, by the way. Yeah, they do a lot of research going back 70 years or more. So those 2 have both been positive. So what we would like to see is the full month to also be positive. So if you look at the rate of change over here, I changed it last week. This was 9 days. We are now 14 trading days into January.
I like it.
Last week, this was 426, I think. So we've actually gone down a little bit. But if it gets above 4.15 by the end of the month, then that puts us in the upper quartile. So if you divide all the years back to 1950 into quadrants, that would put us in the top quadrant of all years.
Interesting.
And this is something I meant to show last week, but I forgot to.
It's okay.
This comes from Earnings Beats. They also do a lot of historical research. So they've looked at from 1950 on. They've looked at what the January ended, the period, the next 11 months from February to December, and then the full year. Okay. And then he broke it into quadrants. So this is the very bullish quadrant, quadrant 1. And you can see the lowest number here is 1991 was 4.15. That's why I say if we're at 4.15 at the end of January or higher, then puts us into quadrant 1, very bullish for the end of the year. On average, the year ends 23% higher. Also in the upper quadrant, 16 years. These are the years that it ended higher. 16 years it ended higher out of 18.
Right.
You can see that 2018 was lower. And I'm not sure what the other one was, actually. Oh, maybe this one, 1987. But it ended higher for the full year.
Okay.
All right, then the next quadrant is bullish, and we need 1.73 in January to be in the second quadrant of bullish. 15 out of 18 ended higher, and the average increase was 13% for the year.
Okay.
Right now we are at 3.2.
Right.
All right, for January. And then the last 2 are bearish quadrants. So here's 2021, where we had a negative January. Still ended up 26%, interestingly. But you can see of all of these, only 2 out of 18 ended higher.
Right.
And the average full year was only 2%. And the last quadrant is when it's negative Januaries. The worst one is 8.57 in 2009. These are actually average negative growth.
Wow.
Right. So we'd like to be in this quadrant 1, and we'll track this the next 2 weeks, basically.
Right.
That's all we've got left. A week and a half, basically, is all we have left of January. So we'll see where we end up, but it would be nice to be able to end up positive. So the last thing I want to talk about here, this is again from my newsletter. I put some charts in here from Real Investment Advice, the newsletter that I get. By the way, one advantage of getting my newsletter, because it's free, is that you will get snippets out of other things that I
that you consume,
that I consume, right? Like VectorVest, which I pay a subscription for, and some of the other subscription services. You don't get everything. You don't get all the cool bells and whistles that I have access to, but at least some of the high level stuff. So this is the CPI 3-month average annualized.
Okay.
All right. And the point that they're making here is the Fed may already be at its target rate.
Yeah, I'm starting to see data like that. Again, this is 3 months annualized.
Right.
But as we just talked about earlier, I'm a little nervous about next month.
Yeah. And 1 month can change this dramatically.
Oh yeah, 1 of 3. Yeah, of course it could. Yeah.
Right. This is the producer price that I just showed. This one here is interesting. This is advanced retail sales.
Mm-hmm.
And this shows retail sales. Corporate earnings primarily come from what consumers do in an economy 70% driven by consumption.
Yeah.
So you can see after COVID, huge demand.
Jeez, look at that.
Ran all the way up there. Came down here, began to return to normal. This is the zero line.
Mm-hmm.
This is where, and that's where we are right now. Consumers are out of money.
Mm-hmm.
So they may not be spending much going forward.
Yeah, we talk about that a lot on my daily shows. Yep. Okay.
Right. So that was an interesting one. This is the one I talked about before.
Mm-hmm. Yep.
Also.
Remember that. Cool.
Right. So there's some good stuff. Vector Vest, I put some of that in. This one here was looking concerning. This is the market climate. This is the earnings trend indicator.
Mm-hmm.
So this takes all the earnings that are reported and future earnings and puts them on a chart. And this line down here, this purple horizontal line is 0. So if it goes below 0, then earnings are negative.
Right.
And that's very bearish.
Okay.
It's been declining now ever since May of this year.
Of last year, 2022.
Last year, sorry. Pretty steadily declining.
Mm-hmm.
But this past month, it's kind of leveled off.
Yeah, real earnings really start not next week, the week after. So we'll see.
Yeah. And then this is the Vector Vest chart that I look at. I have that up every day. Mm-hmm. It shows me the number of buys versus sells, the advancers versus decliners. Cool. Kind of gives me a sense of what the market's doing during the day. Mm-hmm. And it was actually very positive last week.
Very cool.
So that's it for this one. The next session, I'm going to talk about some of the sectors. We're going to review the sectors and see what they're doing. Awesome. And I'm going to point out some things that are beginning to look positive in there.
I look forward to that. Well, Dan,
could all get derailed if inflation spikes higher, right?
Yeah, the 12th or 14th. Yeah, I think it's the 12th. Yeah. Well, whenever it is.
Yeah, so we'll see. Let me show my newsletter one more time.
Yes, sir.
Send me a note to breakpointtrading@gmail.com, and I'll add you to the list. And this is January right here. So CPI report is on the 12th. That was
last month or this month. Yeah.
Yeah, that's this month. So I don't have
February
in here yet. Right.
Very cool, Dan. Well, thank you for doing this. Let's get into video number 2. Take care.
All right. Sounds good. Take care.